If you're listening to this, you're looking for an edge. You're searching for the code that unlocks the market. But the first code you need to break isn't a complex algorithm. It's the code of human consistency. My name is Fabio Valentini. I am known as a successful trader, a scalper of the highest frequency on the most volatile instrument, the Nasdaq futures. But my journey didn't start on a high-tech trading floor in Dubai. It started in Italy, under a different kind of intensity. I grew up near the old heart of the country, where life is built on centuries of precision, the crafting of things that last. My father was a man who worked with his hands, a craftsman. I remember watching him, his focus absolute, every stroke of the chisel calculated. He wasn't aiming for a massive, quick result. He was aiming for perfection in 1,000 tiny steps. This became my first subconscious lesson in trading. When I first encountered the financial markets, not through a finance degree, but through simple curiosity in my late teens, I saw chaos. Everyone was chasing tips, rumors, and quick fortunes. It looked like gambling. But when I looked closer, I saw a reflection of my father's workshop, a machine driven by human action, a mechanism demanding absolute precision and consistency. I didn't start with a desire for millions. My first goal was simple. I wanted to find the statistical edge. I wanted to prove that you could strip the emotion away and treat the market as an auction, a predictable flow of cause and effect. I quickly found the world of day trading. It was frantic, yes, but it was honest. The market tells you immediately if you're right or wrong, and I realized my obsession wasn't with price levels, but with time and volume. If I could master the instantaneous flow of orders, I could achieve the kind of perfection my father sought in his craft, but on the screen. Many dismiss it as dangerous noise, but for me it was the perfect proving ground. It forces the ultimate discipline. You must be right, you must be fast, and you must respect risk absolutely. This realization led to the 5 pillars that define my trading life, the code I had to build to conquer the Nasdaq. You see my results in the World Cup Trading Championships, the 69%, the 90%, the 28% return in a single quarter, and you think of huge daring bets. The opposite is true. The first rule of the code is to treat trading like a manufacturing business, not a lottery. My business model is built on compounding small, statistically robust edges. I am known for taking hundreds of trades, sometimes over 600 in 3 months. That's because I've optimized my process for high frequency, low risk. My core principle, start with a tiny commitment. I set my initial risk at an extremely tight level, maybe 0.25% of my capital. This is not fear, it's strategy. If I lose that trade, the emotional sting is minimal. It's just a data point. The real money is made through compounding profits during the day. I use the market's money, the profits I've already generated in the first few hours, to increase my position size. I'm essentially scaling my risk using house money. If I hit my daily maximum loss limit, which is usually 3 consecutive stop outs, I shut down the screens. The factory closes for the day. This simple, non-negotiable rule ensures that no single emotional revenge trade can ever wipe out my capital. This system is about consistency beating intensity. If you have a 60% win rate on tiny precise trades, and you let those profits naturally grow your exposure, the compounding effect is explosive. It's the lesson of the craftsman. Tiny, perfect strokes build a masterpiece. This is where most traders fail. They apply a flat, rigid risk management rule to a fluid, dynamic environment. They treat an obvious, high-probability setup with the same 1% risk as a shaky, speculative guess. That's illogical. I developed dynamic risk management built around the classification of my setups A, B, and C. Before I place a single order, I assess the market's confluence, C setup. This is a trade where the market narrative is ambiguous or perhaps the volume is low. I risk my absolute minimum, a base risk. It's a probe, an information gathering trade. B setup. The structure is clear, more indicators align, but some caution remains. I allow slightly more capital, acknowledging the improved probability. A setup, this is the perfect confluence. All my indicators, order flow, volume profile, market structure, are in absolute alignment. This setup has the highest statistical edge I can find on the Nasdaq. This is where I commit my maximum yet still contained risk. This approach forces absolute honesty. It prevents me from letting hope inflate the risk on a C-quality trade. I am forced to quantify my conviction. If you cannot honestly classify your trade as an A, you should not be treating it like one. The biggest risk is not the market. It is the ego that refuses to admit the trade is only a B or a C. My true edge, the secret sauce that allowed me to transition from an enthusiast to a verified top scalper, lies in my devotion to order flow analysis. If the candlestick chart is the story, order flow is the writer. It shows you the aggressive intent of institutional participants before the price fully reacts. I'm not waiting for a pattern, I'm watching the aggression. I live on the footprint chart. This tool doesn't just show price and volume, it shows where the volume was traded at each price level, distinguishing between aggressive market orders, which cause movement, and passive limit orders, which provide liquidity, W. I look for absorption when aggressive selling hits a price level and is immediately gobbled up by passive, powerful buying. That's the signal. But the real diagnostic key is cumulative volume delta, CVD. CVD tracks the net difference between aggressive buying and aggressive selling volume. I use it to filter false moves. The Valentini rule on divergence. If the price is rallying, but the CVD is flat or declining, that rally is a lie. It means the aggression is dying. Institutions are not participating. I avoid that move or prepare for a short. If the price is rising and the CVD is rising with it, the move is validated. I enter with confidence, knowing the institutional footprint is there. Most retail traders trade the effect, the price. I focus on trading the cause, the volume aggression. In high-frequency environments like the Nasdaq, this fractional advantage is everything. You can't just execute technical signals, you must understand the architecture of the day. Every day is an auction, and an auction moves between two states, imbalance trend and equilibrium fair value. Defining the narrative, before the opening bell, I determine the overarching daily bias. I study the global correlated markets, like bonds, the DXY dollar index, and the other index. If the major force is clearly bullish, I focus solely on A and B long setups. I refuse to counter trend scalp aggressively against the global narrative. The VWAP compass, the volume, weighted average price VWAP is my compass. It represents the fair value where the majority of the day's transactions have occurred. My highest probability trades often involve fading extreme moves back toward this VWAP equilibrium, but only after I've seen the volume confirming exhaustion at the extremes, my reversal, A setup. The art of avoidance. I teach this repeatedly. Avoid trading the initial market reaction. The first 15 minutes of an announcement are pure noise, liquidity grabs, and traps. I wait for the noise to settle and for the volume to confirm the direction. I would rather miss the first 10 ticks than be trapped in the first 5 minutes. Patience in the initial chaos is an unbreakable component of my survival. My final lesson isn't about the charts, it's about longevity. The lifestyle of a high-frequency scalper, the constant grinding focus on a 1-minute chart, the psychological stress of micro-decisions is not a sustainable model for life. It is immensely demanding. I have achieved great things with scalping, but to build something that lasts, you must evolve. I am now actively transitioning my models to incorporate longer time frames, swing trading, and option strategies. Why? Because I realized that financial genius must be paired with mental health. The core of my risk management is the realization that my time is more valuable than my money. I want to build a system that works, but that also allows me to breathe, to connect with the world outside the screen. This is the lesson that truly separates the wealthy trader from the burnt-out one. My dedication now is to transparency. The trading industry is full of false profits and fake returns. I want to represent the reality. Trading is hard. It requires statistical rigor, constant learning, and zero emotion. Whether you're scalping a few ticks on the Nasdaq or holding a stock for a decade, the code is the same. Know your statistical edge. Control your risk dynamically. Trade what the volume is telling you, not what your hope is whispering. I didn't start with a silver spoon or a fancy degree. I started with a simple belief, learned from a craftsman. Perfection is achieved through consistency. Now, go find your edge.